Hey everybody, we have Tatiana.
Yay!
Hi everyone, how are you?
Great, great. So we're here for
Yeah.
this week's Mortgage Minute, and we're going to talk about the current interest rates and then a topic that comes up a lot for us. We're going to talk about pre-qualification versus pre-approval versus the loan estimate, what that means and how it's important.
Yeah, and how to really, sorry, but shop that loan to get you the best rate from the best lender mortgage loan officer. So we're really gonna, it's important for so many reasons. So we
Yep.
really want to dive into that.
Absolutely. But before we do, what's going on with the interest rates? Oh, I'll tell you on our end, we're starting to see those multiple offers tick up. Had a property, the one that the client that we are working with right now, before she wrote the offer, they had 15 offers in 5 days. So we're back up into the double-digit offer situation at certain price points. So what's going on your end with the interest rates?
Yeah, definitely everybody, sobered up from the holidays and now they're getting back to the home hunting mode. And for the past week from January 5th to 11th, the rates remains pretty steady. And between late October and December, as we remember, rates dropped by more than 1 point. And however, since then, rates have been moved a little bit sideways on the market, but in overall, they're still lower. There were in October 6.656 for 30-year fixed, and we have 6.5 for FHA. I've been actually quoting clients at 6.125 on FHA loans. So
Wow.
they're, or VA as well. Government rates are lower than conventional rates, but overall the data projects that the rates are gonna go down this year. So I think it's great time to buy right now. Again, I never, get tired to reiterate that, because right now it's still slower time and rates are lower. As you said, you already see more multiple offers. We get in the springtime, it's gonna get even worse. So it's time.
Yeah,
But
same.
yeah.
Absolutely.
Yeah.
Okay.
That's right.
Very good. All right. So, and we'll keep doing these every week so that people can track those rates as we do start entering the spring. So we've got two factors. We've got the rates coming down and the natural cycle of the market picking up. So it's going to be kind of
I
crazy.
think it would be a really great thing to do another cost of waiting report. Maybe next week we should do that to show people, we're hearing people say, but I heard by the end of the year, it's going to be, the interest rates are going to be in the 4s.
Yeah.
So maybe doing one saying, hey, now versus if it gets to the 4s in 10 months, but what are the prices going to do and what would you have to waive to get that?
And
so I think it might be really useful for you to put together a cost of waiting report for us.
Definitely, it's a good idea. I'll do that.
All right,
Okay,
great. A new PowerPoint is fantastic. All right. Okay, so we're updated on the interest rates. So we've had this has been since we started our career, and we've tried to explain this to buyers and everything, but I really want this to be a resource that we can use over and over again so that people can really understand what the difference between a pre-qualification, a pre-approval P.O.F.A, and a loan estimate, and why the loan estimate is so significant. So if we can dive into that, I don't know how we want to do this, but
yeah. Okay, so part of the confusion that our buyers had was why I've got my mortgage lending license, right? So that I could really understand it and be able to explain it to buyers/borrowers. And it felt like while I have a really great understanding, I would still get ghosted by potential clients who were offended almost at being asked for a loan estimate for me to be able to compare their rates, to give them my very best. They felt like, well, if you could have done something before, you would have said it already, that kind of thing. So I would like to, let's do a Q&A.
Sure.
And Tatiana, our expert, amazing mortgage loan officer guru, you're going to answer these questions for everyone who has asked and will ask.
Yes. So first question is, what is the difference between a pre-qualification and a pre-approval?
Pre-qualification is just a conversation. I ask what you think your credit score is, how much you make, how much money you have. Based on that information, this is how much you qualify for.
Okay.
It's just very, very preliminary first step, maybe for someone who is not really planning on buying anything. They just want to have an idea what they can qualify for, what payments are gonna look like. Versus pre-approval is when we do the full application, look at the credit score. By the way, now we can do a soft pull before we do a hard pull, if somebody is interested in just checking on without getting hard pull. So but we do pull the credit. We'll look at income documentations and assets and run it through decision engine, which is a very sophisticated program that in 20 seconds analyzes the whole file, the whole complexity of it, and gives us approved, eligible, or not approved. And then you have to play with the file to see what needs to be done to get it approved. I think a pre-approval is not, I think, I know the pre-approval is much stronger than just pre-qualification.
Yeah.
When you write a contract, pre-qualification letter is not gonna be taken seriously.
Right. So I want to hit on, I think, 3 points on that.
And
One,
I've got two.
a buyer can be given a pre-qualification letter. This pre-qualification letter is based on the conversation without actual proof to back it, right? So this is confusion point number one. The buyer believes that because they have this pre-qualification letter, it's what we, your realtor, what we're asking for to submit with the contract or the offer contract, right? And so that's what I want to say. It is not that. It's and when I was taking loan applications, sometimes, rarely, but sometimes I had people say, well, what, do you think I'm lying to you? No, I don't think you're lying to me, but sometimes your Credit Karma score is different than the scores we're actually allowed to use for a mortgage loan. And do you think I'm lying to you? I know what kind of bills I have. I know, but I can't say, trust him, he's good for it. We have to have the actual proof. So it's not a slight to anyone to be asked to provide their social and the facts of your credit standing. So that's one thing. The pre-approval letter is very different from your pre-qualification letter. It actually means something. It means your loan officer has seen all the valid documentation,
Desktop underwriting,
that it's gone through the software, and it's a real valid pre-approval. So go, I'm gonna let you have.
If I can add to that,
Yeah.
I agree with you. People shouldn't be offended because it's not about them lying. There's much more than just the credit score. We do look inside the credit report. We look how new the credit report, like credit history is, how many trade lines, were there any lates, were there any derogatory items. Even if it's a very clean credit history, there might be something that could trigger potentially disqualifying them for getting a mortgage, even though they have a good credit score. There are much more to that. And for the income portion, sometimes people actually underestimate how much they make. And by looking at income documentation, they might actually get qualified for more, but sometimes they would qualify for less because we look at and calculate income differently than the person would calculate their own income, especially if they're self-employed.
Well, and also if it's a relatively new job, right? So some people think, oh, well, I've had this job for a year, this is my income. Well, you can't use that if it hasn't been 2 years. And then and stop me if I'm wrong on any of these points, but likewise, let's say someone said, oh, well, I just started this new job a year ago, so I can't use it. I have to be here for 2 years, but sometimes you can use it if it was in the same line of work, right? So it can go either way.
Exactly. So it all depends on what type of income it is. Just to your point, someone have been maybe on commission for a year only. We're not going to be able to use it possibly depending on the program. So there's just so many little things, nuances that regular people don't know because they're not in this business, right? So it's always good idea just to do the application and get exact information.
And from the buyer's perspective, or from the seller's perspective, a seller is not going to accept an offer, take their property off the market. The seller's agent is going to call your lender. They're going to confirm that you got the underwriting, that they've seen the documents, that that this is a true valid pre-approval letter. And if it's just a pre-qualification, the seller is not going to take the property off the market when they have three other offers that they can consider. So,
right. Well, and one more thing on that point is we know how to decipher a pre-qualification versus pre-approval. We also will always contact the lender, but not all agents know that and not all agents do that. So to protect our clients, you, the buyer, you do really want to have the pre-approval for yourself, because let's say you only go in with an offer on a pre-qualification. The agents, yours and the seller's agents, don't know what they're doing. It's accepted. Then you start going through the actual underwriting process, realize, oh, wait, we can't do this. And then maybe you lose your earnest money deposit and it sets you back and you can't buy yet because you've lost what?
15, 30,000.
Yeah, thousands of dollars because you haven't done this extra step for whatever reason, and some of those reasons are, well, I don't want it to hit my credit. Let's talk about that, right? It hitting your credit, you said a soft pull versus a hard pull, and then they're worried about applying with multiple lenders because they think it's going to affect their credit more than just one time. Can you address that?
So, the mortgage, going back a little bit when you were talking about different credit scores, the mortgage companies use FICO 2, 4, and 5 to pull the scores. All known soft pull companies like Credit Karma or CreditWise, they use Vantage or they use FICO 8. It's different algorithm. They don't go farther than 2 years in the history. They don't look at some of the collections if they're like less than $100. So because of that, their credit scores are higher than this credit score that we get. Again, FICO 2, 4, and 5, that's what we use. And when we pull the credit, it does not lower our credit score, the score that we look at. The client might see the score drop on Credit Karma, but we don't go by that score anyway, so it doesn't really matter. And also, they have 45 days for multiple mortgage inquiries as considered as a one inquiry. So it's not gonna change their score even on their end after the first inquiry. But now we do have a soft pull. At some point we will need to do hard pull later on, but in the beginning, if we just want to see what the score looks like on our end, we can do soft pull.
So as a non-lender, because I know you guys have this special language, so as a normal human, you're saying that if you check my credit, this is before you could do your soft pull, so let's talk 6 months ago. If you checked my credit and my Credit Karma score went down a little bit because it took a ding, you're saying the credit score that you were looking at, you don't even care about what this does. The one that you're actually looking at is not affected by you pulling that credit, and they have 45 days to do multiple pulls on that credit, and it doesn't matter.
correct.
Interesting. I didn't know that.
Yeah, and 45 days is plenty of time
Oh, yeah.
for you to secure
Some
the
pre-approval.
home loan
yeah.
and know really where you want to go with
Yeah.
that, right?
So just to throw a little bit of confusion into this matter, there are certain banks, I know one, I'm not going to mention them, P.O.F.A, that their pre-approval letter says very clearly on the top of the letter, pre-qualification. So some banks, some lenders will put their, label their pre-approval letter as a pre-qualification. So that's where the buyer's agent needs to really do their diligence and make sure that everything was done appropriately.
Right. So the company I worked with, Tatiana, it was topsy-turvy from how we, as a real estate agent, talked about it. In our company, a pre-qualification was the serious one where they'd actually run it through DU. And their pre-approval was just the conversation. So I had to, it's like, wait,
Interesting.
so the banks can,
They have
their
their own
lingo can
language.
also be different.
Yeah, yeah.
That's interesting, but I think what's important is not the header of the
Mhm.
name of the letter,
Yeah.
but what's inside the letter, right?
Yes.
So
Yeah.
inside the letter, it needs to say it's based on us reviewing income, assets, documentation, and running it through desktop underwriting. That's clearly a pre-approval versus if it says that based on conversation or whatever language would be on a qualification
Yeah.
letter. Mhm.
Okay.
Yeah.
So that's what you need to pay attention to, what's in the body of the.
Right,
Okay.
in the body, not necessarily, not the heading so much as the body. That's very, very good.
Okay. All right. So now, so we've talked about the first two. Now let's just briefly, because I know we can go deep dive on this, briefly talk about the P.O.F.A, the difference between the P.O.F.A and the pre-approval
The
letter.
pre-offer full approval.
Yes.
So the pre-offer full approval, P.O.F.A, is different because because that's when we actually it's equivalent to a full approval. We send the file for a full approval to underwriting. When the underwriter, a person who has higher level of authority, they'll dissect the whole file, that we do verification of employment or any other verifications we need to do. So they look at the file deeply and they say, we commit to lend you the money. Maybe they'll ask for some additional documentation before we finalize and give a, clear to close, right?
Yes.
But that would be the commitment letter. The P.O.F.A is the one that you would do while you're looking for property. There is no property identified yet.
Yeah.
The regular commitment, and a lot of lenders don't do P.O.F.A. They wait until you have a property and then they can send it to underwriting.
Right.
We can send it before that, and that's two pretty much similar things. It's one that has property, and other is to be determined, but it's a full approval. It's basically you're gonna get a loan,
Right.
as long as maybe you find the property and
It's so,
adequate.
yeah,
Yeah.
it's so key because we can write your offer not contingent on loan approval,
Yeah.
which is huge. Now you still have appraisal.
Yeah.
And you still have to find the property, right? But that's huge.
It's
I
almost like a
mean,
cash buyer. We can shorten the settlement dates. And
Yeah.
don't you guys offer the $10,000 close on time if there's a?
Yeah, so we call it 10,000 closing guarantee,
Yeah.
something like that. Basically, where we say that if we drop the ball and we don't close on time because it's our fault, we would give $10,000 closing cost credit to the seller.
Yeah.
And I'm telling you, this company, they could make it $100,000 because you guys never drop the ball.
I've never
on
had
wood.
that happen, no.
This is a very safe guarantee for this company.
Okay. Okay. So we've got pre-qualification to pre-approval to P.O.F.A. So even in any of these situations, pre-approval or P.O.F.A, now we have got a ratified contract and we get a loan estimate. So tell us about that, what that means, and you have a further.
Well, I do have a further question because oftentimes we get to that point where we're under contract and then the buyer decides this is a great time to shop the loan because someone else has offered a better rate. So that's when we say, okay, well, there are a couple of things to consider here. One is when we submitted the contract offer, we submitted the pre-approval along with it, naming a certain mortgage lending company.
Yeah.
To change that means that we have to at least alert
Mhm.
the
Notify
seller
them.
about this,
Yeah.
right? When you bring someone else in, typically we're trying to do a really, really short contingency period. And if you're bringing someone else in that has to play catch up, right, just for this better rate, then there's a little bit of jeopardizing of your EMD here.
Yeah.
That's risky. So then let's say Tatiana, you're the lender that we submitted the pre-approval for this offer with, and let's say I'm the buyer, you're my agent, and I say, hey, I'm really glad we're under contract, but Navy Fed offered me a better rate than Tatiana, so I'm gonna see if I can get an approval from them. What do I do?
So a couple things, especially if we have a shortened closing period, like we have a 2-week close, Navy Fed will never meet a 2-week settlement. So even if you get that cheaper rate, you're never going to meet
Okay,
the
let's say it's
settlement.
someone who is quick.
Okay. Well, then you have to have that the loan approval, our loan estimate. You have to quickly have the conversations back and forth, and you have to decide within a day or two because
What do you mean a loan estimate?
So that's what we're talking about. The loan estimate. And why is the loan estimate so important? Why is that what you need for your currency to determine what the actual competitive offers are?
So the loan estimate is a worksheet that shows the breakdown of the interest rate, the monthly payment, the closing cost. When someone is shopping for the rates, and why would you shop the rate when you're under contract? One of the reasons, because rates change every day, right? So if you got pre-approved a month ago, the rate is different than what it is now. Hopefully, when you write in an offer, your lender gives you a breakdown of an estimate for this particular property, so you know what rate is going to be. So, but the estimate shows all the breakdowns, and when clients shop for a rate, they need to look not just at the rate and the bottom line, how much they need to bring to settlement, or what the payment it is, but they need to look deeper. They need to see, are there any fees associated with that interest rate? Because I can quote someone 6% interest rate and another lender give them 5.5%, but they charging $15,000 in points. So I can maybe do the same or even better. So you want to compare that. You never look at the very bottom line. Some lenders under disclose closing cost. Some lenders over disclose. I prefer actually over disclose them, because when client comes to settlement and they need to bring $3,000 less than what they thought, I think it's better than vice versa, right? They need to bring
Yeah, absolutely.
3,000 more. Also, in some cases, we need to look at the monthly payment breakdown. Sometimes clients just look at your monthly payment is higher than somebody else's, but sometimes lenders don't include homeowner association dues in breakdown, or but they have a mortgage insurance that is $100 higher than mine, but they didn't include HOA. So you need to look deeper into that. And when someone, you work with the lender for period of time, and then you just go to someone else because you think they're doing better, you want to give opportunity to your lender to actually look at the estimate and match it or beat it. And the reason why we need an estimate from another lender, if it's better estimate, to try to match or beat, is not because we just should have done something better from the beginning. We have certain level of authority to go to the certain level, like certain bottom line of the rate. And if it's something lower, we need to go to management and say, here is the estimate from XYZ. what can we do? Can we
Right.
beat or can we match? I can't just go to my manager, say, this company is giving 3% interest rate, and we just, oh my gosh, let's just give 3%. You know,
Yeah.
you have to see what it involves. Maybe it's a 1 year arm negative amortization with
Yeah.
25,000 in points. Like, how can you get to this low rate? So we
Yeah.
need to look, and it's good for you for a second set of eyes to look and point out things. Good for you as a buyer.
Yeah.
Yeah.
To point out, okay, well, it's great, but it's actually pretty bad deal. You paying so many points, you're gonna recoup the cost of it in 15 years. Does it make sense for you to do that? So that's very important.
That's exactly right. I used to tell borrowers, I'm like, if you think of this loan estimate that I'm asking you for as my ticket to get a seat at the table with the big guys to be able to give you a better deal. This is my, I have to have this ticket to go into that room to try to work this deal for you.
That's a great point.
Yeah.
Definitely.
That's our ticket.
You can use that.
I will.
Your ticket in the room.
And I want to say that we've had several clients that have come to you with their loan estimates, and you've been able to beat what they were doing. And they were considering switching because the interest rate was lower or whatever, you know, factor. And they ended up coming back to you with it, and you pointed out, yeah, but they're charging you this, or, you know, I can get you that. And if I get you that for the same price, it's actually going to be at this percentage rate.
Yeah.
Or so you've beaten a lot of people with that loan estimate once they come to you with that.
Yeah, Tatiana, you usually either show that your rate was already better whenever you show them what they're actually looking at, apples to apples, or like you said, you
Yeah.
go in and you're like, I mean, yeah, I can do that and it'll be better.
Yeah.
It's really great.
Yeah.
And
Okay.
I think, you know, when you work with someone, just give them a chance, because loyalty is a good thing.
Yeah,
That's
absolutely.
right.
Yep. And so that loan estimate, that is that what happens? Is that with the lock? Like, do you only get the loan estimate once you lock the loan, or do you get the loan estimate and it can still be floating? Because that could
That's an excellent
change.
question.
With Prosperity, we give estimate from the beginning, even if there is no property, if there's you know, just from the very beginning, we give the estimate so clients can see what to expect. I know some lenders, I'm not gonna name them, but they won't even give an estimate. They won't even quote a rate until there's a contract. I'm not sure how it's even possible and somebody would take that, because
Right.
you taking something you don't even know what you taking. Can
Yeah.
you afford this? Maybe in lenders' eyes, you know, you qualify for it, but not necessarily you're gonna afford it. I had so many clients that qualify for much more than they want to spend. So it's important to know what your payment is gonna look like. Maybe you qualify for $7,000 monthly payment, but you don't want to spend more than 3,000. Now you're under contract and your payment is gonna be 7,000, and you're gonna be stuck with that if you can't get out. So it's important to have an estimate from the very beginning.
Yeah,
Okay,
absolutely.
makes sense.
Yes.
All right.
Anything else that we need to add to this topic?
No, I've gotten all my questions answered.
I think, you
My
know,
eyes are doing this.
I think we covered it all. It's just, it's important to get pre-approved.
Yeah.
Don't get offended of getting pre-approved, and don't get offended if you know, you're trying to get a better rate, and just give that estimate.
Yeah. And to know that, you know, we're all in it on the buyer/borrower side. Like we want you to have the best rate. We want you to get the best deal. We want everything to work out perfectly for you. So let your agents and let your loan officer really work for you. Let us in every aspect. Let us know what you're thinking. Don't ever ghost us because you're worried about either asking too many questions or giving out too much information or whatever. We understand that your lives are still going on and there can be more and less chaos and stress at times, and to have patience with yourself, because there is a lot going on with your lending and with the real estate market and with the contracts, that you're not expected to know it all, and that's what we're here for.
Yeah, and you know, just you also need to look beyond. Sometimes we need to look beyond just numbers, right? Because you're gonna get a better rate, you're gonna get terrible customer service, you're gonna have a delayed settlement. You don't know what's going on. Everything is messed up. So
Right.
just for maybe $10 less a month in the mortgage payment. So you need to analyze and see, does it even worse going somewhere else just for a
Right.
little bit cheaper loan?
That's very true. We've had several lenders that we've worked with clients who seem to not actually read the part of the contract that says that our buyers' deposits are going to be lost if they don't get either a denial, an official denial, or approval by a certain time, right? So they don't seem to be aware of that. And so on our end, we really have to stay on top of it. When you work with someone like Tatiana, you don't have to stay on top of that. They're aware and they're sensitive to the fact that you have a lot of money on the line and that your deadlines are vitally important to this deal and your household state, right?
We've had two very specific deals that we've had multiple issues with bigger banks. But we've had two. We had one with a national bank that the loan officer was actually in New York, that we were fighting tooth and nail with them just to get a supervisor on the board and get above that supervisor to get somebody to honor the fact that we needed this
I'm sending
document.
contracts with highlights
Yeah.
about around the paragraph of, do you
Yeah,
understand?
because our buyer was about to lose their EMD just because the bank didn't meet the deadline. And then we had another contract with a local big
And that one
bank
was
here.
over $20,000 that
Yeah.
we were about to lose.
Then we had another one with a $2 million property here that it was a $85,000 earnest money deposit. It was actually Kelly's first deal. It turned out being her first deal as a lender because she recognized at the very beginning of the transaction that this large bank was not going to be able to fund the loan. So she jumped in and her bank was able to do it. But that bank, because it was so difficult, it got down to the wire even with her company to be able to do it. But that big bank never gave us a denial letter. We had a 21-day finance contingency and they said, oh, it's going through the process. And they never gave it to us. So if they hadn't pulled it out, he would have lost his 85,000.
Right.
So it is very important, the lender that you work with. It's critical. It's not
Yeah.
just about the interest rate.
Yes.
Sorry.
You know, in some states, even contracts are different from state to state.
Yep.
Even within the state, sometimes it's different. And some contracts say suggested closing date is such and such. Here in Virginia, it's not a suggested date. This is the
It's
date.
on or before, man.
Yeah. So, but the lender that work in the state where they're all
Suggested.
relaxed, I don't know,
Yeah.
you know, bathe in the sea and they don't really care. They're not gonna be in a hurry. They say, okay, well, this suggested date, and when date comes, they say, well, but it was suggested. We're not ready. We need another 2 weeks extension, and
Yeah.
everybody start pulling their hair out because that's not like that here in Virginia.
Yeah.
Yeah, that's true.
Right.
That's true. Okay, I think this was excellent. I'm sure we're going to be sending this to a lot of people.
Yes. I was gonna
I hope we all
email.
like our hair.
All right. Well, okay. So everybody knows how to get in touch with us on our end. How do people get in touch with you?
You can contact me at any time, 571-245-3000.
Okay.
All right.
All right.
Thank you,
See you
Tatiana.
next week.
Thank you, guys.